After the smoke of 1907 cleared, Paul Warburg didn't just want a better emergency currency, he wanted a system. This episode spotlights his 1909 address, later printed as a central bank system in the United States of America. The big question he asks is practical. How do you take a country of thousands of banks and give them one backbone strong enough to handle panics without politicized tinkering? So Warburg's lesson is that reserves beat rhetoric. Centralize the nation's reserves, make deposits with the central issue department, which count as cash for member banks, and run credit policy through a disciplined rediscount mechanism, not ad hoc note printing. Then, fix the old national banknote tangle by inverse conversion. For example, swap 2% circulation bonds into 3% without the privilege, and dedicate the central institution's surplus earnings to strengthen the gold cover and gradually retire greenbacks. In short, unify reserves, standardize the discount pipeline, and clean up the legacy currency so the safety net is elastic but rule-bound. So, what exactly does Warburg propose? In the 1909 address, Warburg takes two decisive steps that define the system in central bank system. For one, you count central balances as cash. So he argues the Central Department of Issue should be allowed to require banks to hold a proportion of the reserves with it. And, crucially, the law must let banks treat those balances as cash in their own reserves. That turns scattered, inert vault money into a single, mobilized reserve that can be pushed where it's needed during stress. It's a sharper version of the European practice he admired, one big neutral reserve, many private pipes. For two, clean up legacy currency with rule-based finance. So in the same address, he proposed an inverse conversion of the 2% bonds that backed national banknotes and exchanged them for 3% bonds without the circulation privilege, while channeling the net earnings of the central department to the government so that it can steadily build gold cover behind the greenbacks or retire them. That's important. It uses the central institution's earnings to strengthen the foundation of the money system, not to chase profits. So those two pillars sit inside a broader philosophy he repeats across the essays that he writes. Don't obsess over note issue first. Get the reserve architecture right, and the notes will behave. In Warburg's words, premature note tinkering is like hitching a fresh horse to a broken carriage. The main job is reserve centralization and liquidity via rediscount. So his explicit that balances at the center should function as the first-line banking reserve, and that standardized short-term paper must be convertible into those balances quickly and without red tape. That's the engine room of the system. Finally, Warburg links this to governance and incentives. Keep the central organ neutral and profit limited, and use surplus for public balance sheet goals. Gold strength, greenback retirement as two examples. That alignment reduces the political and speculative temptations that worried reform skeptics. The upshot, a rules-anchored lender of last resort that works through banks, not around them, elastic when needed, and disciplined always. So this episode is Warburg's system at scale. He's not just sketching a central bank. He's showing how to wire a continent-sized banking network so that panics become manageable liquidity squeezes instead of full-blown breakdowns. Count central deposits as cash to concentrate reserves, standardize rediscounting so sound paper is always liquid, and use the institution's own earnings to fortify the gold base and phase out weak legacy currency. Build those rails and the monetary train runs on time, even uphill.